EasyJet shares soar after it says it expects to fly more passengers in 2025. Welcome to Market Insight, I'm Ramzan Karamali. Well, the budget carrier reported annual operating profits of £597 million, up a quarter from last year, but lower than market estimates. It's been hit by disruptions from the Middle East conflict. These were the last results of outgoing CEO Johan Lundgren. So what kind of business will he leave his successor, Kenton Jarvis? Well, to help answer that and more, I'm joined by Zoe Gillespie, Investment Manager at RBC Brewin Dolphin. Zoe, thanks so much for joining us. So overall, what did you make of these annual results from EasyJet? How do they compare to the likes of, say, Ryanair and Wizz Air?
I think the takeaways for me was the fact that they have seen an increase in, as you say, operating profit. Although despite the fact that they've maybe come in a bit light, I think broadly it was a decent set of numbers. I think interestingly we've seen capacity increase, although we're still down on the kind of pre-pandemic levels, which I think is maybe why the share price hasn't got back to the levels we've seen before the pandemic. Interestingly, they've increased the dividends, so there seems to be a little bit more for shareholders. And I think the outlook looking into 25 seems strong. They're talking about increasing routes to Canaries and North Africa. So they're looking ahead, I think, at sort of longer haul flights. So on the surface, I think it was decent numbers. Market reaction's been a wee bit muted, but certainly I think better news if you compare to the likes of Ryanair, which saw profitability really being impacted by certainly lower cost per or lower ticket per person. And I think certainly EasyJet has benefited from having the holiday business as well, which has certainly boosted revenue too.
Does it also make a difference that EasyJet's main supplier is Airbus, whereas Ryanair look more towards Boeing?
Definitely, and I think that has been a takeaway a lot across the kind of airline industry. And the fact that EasyJet is only using Airbus has helped in terms of capacity, and certainly there has been less disruption. And that has been an impact on Ryanair's numbers too. But I think generally, I think that the move and the diverse business of EasyJet has been an area of growth. And we have seen, as I say, the holiday sector has been popular post-pandemic, and actually having the holiday business as part of the overall offering has really helped, I think, diversify and make a difference compared to its rivals.
I just want to pick on something you said earlier, that EasyJet's forecasting a positive outlook and looking to grow longer leisure routes. What do you actually make of that strategy? Is that really a good idea at this time?
Well, it maybe feels that it's going into, I don't know whether it's winter sun. I think we've always seen that the airline's been quite skewed to the summer months. And certainly if the carrier can have more routes in longer haul places, then it might expand on their offering through the winter months, which tends to be a bit of a lag. And clearly they've done the numbers and they feel that it's something that they want to go into. So I think it shows maybe an expansion in terms of trying to balance out the reliance in the summer months.
Now, I mentioned these were the last results from the current CEO, Johan Lundgren. How do you think he'll be remembered and what can we expect from his successor?
I think it's been a difficult time. He's been there for 7 years, and I think certainly the pandemic was a difficult time for him. I think it fared less better through the pandemic than the likes of Ryanair, which was able to keep staff and fleets, I think, in kind of there, so they were able to adapt more quickly when restrictions lifted. So I think from his point of view, the share price is 50% lower since he took over. So that's, again, probably a lot to do with the pandemic. But I think from a positive momentum, he did introduce the holiday business, which when you looked at the time compared to the likes of Thomas Cook struggling in other areas, it was quite a brave move and something that I think will probably be his main legacy.
Now, on the flip side today, in terms of share performance anyway, was Pets at Home down over 12%. Do you think investors are right to be so down on the retailer after its latest set of results?
Yeah, I mean, there was growth in revenue, albeit quite modest, below 2%. And I think the takeaways for me was that the retail business is still struggling. And I think we saw after the pandemic, people were very much buying pets. And I think certainly that there was a huge surge. The takeaway, though, again, from the better side of things was the veterinary business has grown. And certainly we've seen revenue growth of nearly 20% there. And that's an area for expansion because you can't really convert that to online offerings. But I think we've seen the budget having an impact on many retailers. Their costs are going to go up. So from Pets at Home's perspective, it's how it's going to adapt to potentially increased costs and low growth. So I think the share price probably reflects the fact that there wasn't much positivity in the results. But I think certainly it's been a tough time for many retailers and Pets at Home's another one that has really struggled with the cost of living.
Interesting stuff as always. Zoe Gillespie from RBC Brewin Dolphin, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.